Chapter 2, Forex Basics. In this chapter, I'm going to go over the benefits of Forex trading, what is Forex, what are currency pairs, what are pips, and I'm going to explain sessions and time of day to you guys as well. I want you to understand going forward, though, that this basic content is very important when trying to enter and exit the market when we get to chapter 14 and 15. You need to grasp these basics completely. That way, when we get to the super advanced stuff, you're already flowing through all this, you already understand it, and it's easy to implement into the market. The first benefit of Forex trading is the capital requirement is lower than many other markets. Now, this also depends on the broker that you choose to trade Forex with, proprietary, regulated, unregulated. There's so many different brokers to go with, and that really depends on where you are financially in your life. But for the most part, there's lower capital requirements to get into trading Forex. And the fact that there's no pattern day trader rule should really make anyone that's interested in, I might get started in penny stocks or small caps, or whatever, I might get started trading stocks, or maybe I want to get started in trading something else, but I don't know anything else. What else is out there? Oh, Forex is out there with no pattern day trader rule. Great, that helps me because I wasn't going to start with more than $25,000 and be above the PDT rule. You know what I mean? So understand that the low capital requirements in some situations is an advantage to getting involved in Forex, even if it's just to test the waters and see if you have what it takes to be a trader. That's a benefit of the Forex market, is that you can get involved with a lower amount of starting capital. Another huge benefit is that the market is open 24 hours a day, 5 days per week. So that means that from Sunday evening, New York time, which is the morning for Australia, the market opens and it runs nonstop all the way through until Friday evening, New York time as well. So we go Sunday to Friday. Now, that's very appetizing. It makes people lick their chops and want to get trading at all times of the day, all times of the night, because they heard that this thing works then and this thing works now. In my opinion, and we're going to get into this later, the fact that the market is open for so long to a day trader should almost throw a red flag at you and be like, hey, they're trying to signal everybody in to get into the market 24 hours a day, 5 days a week. Us profitable people, we're going to get in and get out and take our money and move on. That's how we're going to look at the market. So yes, the market is open, and that is a benefit of Forex, that it's open for so long and so available to so many people. But I want you to look at that with a fine-tooth comb. I want you to understand that there's a reason for that. Whether I'm right or wrong, the psychology of what I'm saying is important to apply to yourself as a day trader. You want to look at it like they're trying to induce you to trade at all of those times. The market wants you to be involved so it can keep your money in, so that it can charge you swaps. A swap is what happens when you hold a trade overnight. So understand that this is still a business, guys. They still want to make money. So they want it to be appetizing. That's the point. Leverage is the silent but deadly killer of Forex trading. Well, probably not that silent for anyone that's been blown out of an account. It's probably very loud and painful, but you get my point. What I'm saying is that leverage can kill you if you're not smart. So there are brokers that offer crazy amounts of leverage that are unregulated in all these weird countries that we do not recommend people getting involved in. Those high levels of leverage do not lead to long-term consistent trading. Appropriate leverage is necessary, and Forex gives you the ability to find the appropriate leverage for you. It's not 1-to-4, 1-to-2 like it is with stocks. There's a lot more leverage available, and it depends, again, on the broker that you choose. Proprietary, regulated, or unregulated. You have a lot of options, and it all depends on your personal financial situation. I can't give you that exact advice via this video course. You need to get in the market, do some research, give Google, come on, you can figure this out on your own. You know what I mean? I did. The leverage part, the broker part, it also depends on your country, where you live and things like that. So there's a lot that goes into leverage, but understand that there is leverage out there that for the people who understand how to trade profitably, leverage can be used to your advantage. You don't need to be scared of it. Another benefit of Forex trading is the minimal commissions and the trading fees are very low. A lot of brokers don't even charge you a commission. They're just charging you a spread, or vice versa. They don't charge you a spread and they charge you a low commission. Because of this vast network of how the brokers are connected over the internet, it's increased the competition. And when competition goes up, prices for us consumers go down. So it's made the cost of doing business a lot cheaper, especially in the Forex space. Let's talk a little bit about what is Forex. A lot of people ask me that all the time. How could you explain it to someone in like an 11-second elevator pitch, right? Forex is an over-the-counter market where banks, businesses, governments, investors, and traders like you and me all meet to speculate on the value of currencies. Speculate meaning we trade. I think it's going to go up, you think it's going to go down, or vice versa. The need to constantly exchange currencies for international trade is one reason why Forex is the largest market in the world. Over $5 trillion is exchanged daily. Now, let me just give you an example of that so you understand it without me just reading a bullet point to you. That means that if a car company in America wants to build cars in a different country, they're going to need to use dollars to exchange for that other country's currency to build the car plant, pay the workers, do what they need to do in that other country. That right there is an exchange of currency. That is a large Forex exchange. It's not the same way that you and I are looking at it to profit on the day-to-day movement of the currency. They're looking at it to get the best price for their currency because they need so much of it. And those are the big moves that cause the market to be so liquid, cause the market to have so much daily volume turned over. You see here, $5 trillion a day. It's because you have huge governments, banks, businesses, corporations throwing money in and out, doing a lot of international trade. And that's only going to increase as globalization gets bigger and bigger and the world gets smaller and smaller. All the transactions are done between traders themselves on the internet, on the ECN networks. That's because there is no central marketplace for Forex. Because there's no central marketplace, different brokers can quote currencies at slightly different prices. And I'm sure you know that. If you trade any other market, you know that. But that's an important piece to be aware of because some brokers can move spreads differently. Some brokers charge commissions differently. And that's because there's no central marketplace. So make sure that when you get started, you know who you're trading with, meaning your broker. You know all of their rules, all of their ins and outs. Are they regulated? All of that stuff. You want to really know who is holding your money. Look at your broker like a bank account. Currencies are traded in pairs, meaning there's major pairs and cross pairs. Major pairs are any pair that includes the US dollar. Cross pairs are any pair that does not include the US dollar. For example, Euro New Zealand dollar, like you see here, or New Zealand dollar CAD. Those are cross pairs, anything that doesn't include USD. And I want you guys to also be very aware that the three most traded currency pairs are the dollar, then the euro, then the yen. Those three pairs are the ones that are doing the most transactions day to day on average. Let's talk a little bit more about the major pairs. You have the euro to the dollar, euro USD. You have the United States dollar to the Japanese yen, USD JPY. You have the United Kingdom or Great Britain pound to the US dollar. You have the US dollar to the Swiss franc, US dollar to the Canadian dollar, Australian dollar to the US dollar, and New Zealand dollar to the US dollar. These are your major pairs. Anything with the US dollar is a major pair. Now let's go over a few cross pairs. Pairs like Euro GBP, Euro AUD, Euro CAD, Euro NZD, Euro JPY, GBP JPY, GBP CAD, and GBP NZD. All of these pairs are cross pairs because they do not include the US dollar in them. So let's talk about pips. What are they? Well, pips stands for point in percentage. Pips are how we measure movement of currency pairs, just like when you're trading stocks, you count cents and dollars. In this example on the screen, I gave you Euro USD priced at 1.34567. The 5 and the 6 are the two numbers that I want you to focus on. The 6, which is the second to last digit in this example, the 6 is the pip. That is your ones digit when counting pips. The 5, this placeholder, that's your tens digit when counting pips. So if we go from 56, 1.34567 to 1.34577, that is an increase of 1 pip. If we go from 1.34567 to 1.34667, that changed the 5 to a 6, which increased us 10 pips. And just as we would move that to the left one more time, 1.34567 to 1.35567 is an increase of 100 pips. Now you're going to say, Austin, what's this 7 on the end? Well, that's what some people will call the micro pip. We're going to call it the pipette. That's just like the almost like it when you're counting regular numbers, it's like the decimal. It's the add-on. Until you're trading super large lots, the pipettes are almost, they're very minuscule amounts of money because they're not even a full pip. It's a fraction of a pip. All right? So we're going to count the pips by looking at the second to last two numbers. We're going to quickly train our eyes to looking at the second to last number in this example, the 6, as our ones digit, the 5 in this example as our tens digit, and the 4 as our hundreds digit. So when the price changes in each of these digits, I can know, okay, we went up 10 pips, no, 20, no, 30, no, 100, just by looking at those placeholder digit places right there, the 4, the 5, and the 6 in this example. Let's talk a little bit about sessions and time of day. There's 4 major sessions in the Forex trading day that you should be aware of. We're only going to discuss 3 of them once we get into the trading aspect of all of this, but there's 4 that I want to educate you on. First, we have London from 3 a.m. to 12 noon Eastern Standard Time. All this is going to be New York time. That's because that's where I'm located. New York, that session starts at 8 a.m. to 5 p.m. Eastern Time. The Australia Sydney session, that starts 5 p.m. Eastern Time to about 2 a.m. And the Asia session goes from 7 p.m. Eastern Time to 4 a.m. I'm going to give you a little bit of info on each one, so follow me through here. First, let's talk about the London session. The London and New York sessions, when they trade together, because they do overlap at some point, you will see the most volume possible. The London and New York separately are the 2 most traded sessions as it is. So typically, you're going to get the lowest spreads, you're going to see the biggest moves. That's what's going to happen. You have pairs that are like GBP, USD, CHF, and Euro. All of those pairs, the pound, the dollar, the Swiss franc, and the euro, are all going to be very active during the London session. You got the London banks open, the American banks start to wake up towards the end of London, so everybody starts getting their day going. A lot of news releases come out in London. It's a very volatile, very profitable time to be trading. New York, the New York session, 8 a.m. to 5 p.m. We're looking at high volume, just like London. A lot of news-driven reactions create the volatility because you have news releases that typically come out between 8 and 9:30 a.m. every day. The volume does begin to fade in New York after 12 noon. There's 2 reasons for that. I like to tell you that it's because the traders had a big meatloaf lunch and then they want to go home and take a nap. But the real reason, I think, is because the London session starts to die off, traders start to close out their positions, and everybody starts to go home. So as London closes, volume leaves. As New York closes and traders close their positions, volume leaves. 2 o'clock, 3 o'clock, 4 o'clock. The spreads start to get a little bit bigger. The market starts to slow down a little bit. So you need to be aware that New York is a little bit more active in the beginning of the day than it is at the end of the day, and that's just logical because people go home at 5 o'clock New York time. You know what I mean? Quickly, we'll talk about the Sydney session. Liquidity is very thin here. I personally do not trade the Australian session, the open, or anything like that. It's the slowest session of the day from what I've seen and from everyone that works with us. And there's very few opportunities that even present, so it's better to just analyze. Let the Asia session and the Australia session develop. Let them set the initial high, let them set the initial low. But personally, we will not be trading during these sessions. And lastly, let's talk about the Asia session. So some people will call this the Tokyo session. I call it Asia. You call it whatever you want. It's on the other side of the world, 7 p.m. to 4 a.m. Eastern Time. Liquidity starts to build for the day. This is now 2 hours after Australia has already been open. And some pairs will trade within the initial high and initial low. They're going to set a range and they're going to trade until about 1, 2, 3 a.m. when London kicks in, and then they begin to move. JPY, the Japanese yen, New Zealand dollar, and Australian dollar are going to be the most active because these countries are open and active during this time of day. Just because we're asleep doesn't mean that their banks aren't doing transactions with American companies. So there's still trades in Asia, 100%, especially coming out of Asia at around midnight, 1 a.m. Eastern Time, going into London, 2 a.m., 3 a.m., you can find a lot of great moves. So understanding how all 4 sessions tie together, where Asia and Sydney, you have liquidity building, volume building. London, you start to get some movement, some trades. You get some gas because banks are opening, businesses are executing the trades that they planned the week before, yada, yada. Then you have some news releases come out typically, and then New York gets going and a lot of volume builds and builds and builds. And then by 12 o'clock Eastern Standard Time, it starts to fade. London is closed. Sydney's already been closed. Asia's been closed. And we are just fading into New York, waiting for Asia to reopen. And it's a cycle that you should be aware of and start to study. Check the charts at 9 o'clock at night, guys. Just pop on, see what's going on. Did they set the high and low? Oh my God, that box is crazy. Start to feel it out, and you'll see the cycle at work.